Okay, so welcome everyone to this CIMA exam revision series. This is level P3, session 1. There's going to be 3 sessions. Let me say straight away that in 3 sessions we can't cover the whole syllabus. One thing we were hoping was that students would send in questions so we could tailor these presentations. But we've not had many questions, so I've had to decide what it is that I think you need to know, and we'll go from there. My name's Cliff Bowles. I'm a professional tutor. I teach a lot of CPA people. I write a lot of courseware. I teach ACCA. And I've been financial controller of lots of businesses. I've owned lots of businesses and ran lots of businesses, so I know a little bit about what we're going to talk about. Tonight, we're going to cover 4 chapters. Corporate governance and ethics in the first part. They're related quite a lot. We're going to have a little break, and then I'm going to do financial risks and audit and review. And at the end, I'm going to start to look at the pre-scene and see, of these 4 chapters that we're going to do, what are the elements of the pre-scene that we need to be aware of. If Neil, you've got a question for me, yell out as I'm talking.
Yep.
I don't mind if you interrupt, that's fine. Yep. I'm going to ask you lots of questions, so it's only fair you should be able to ask me questions. So, okay. So let's get on with corporate governance, and let me read something to you first of all. As tutors, we get information from CIMA that perhaps you don't get, and I'll read some of it to you. Corporate governance is a key area in the P3 syllabus, and one of which students must have a good knowledge as it is frequently examined. So, this is the reason I've included this. I'm not going to go through all of these slides. You've got your own material. I'm just going to touch on some of the things that are important. Corporate governance, there are lots of definitions of corporate governance. This one here is quite simple, a system in which companies are directed and controlled. And if that's all that's required from you, then that's all you need to know. There's lots and lots of examples of poor corporate governance. If you haven't already, I suggest you watch a film called, and I have it here, I don't get a kickback from these people, but it's called Enron, the smartest guys in the room. That will tell you more about poor corporate governance than 100 webinars could. I recommend you watch that. It talks about how things can slip from being a well-run company to something that's poorly governed. The usual thing is that there's some dominating characters, not just necessarily one. So you need to know what sort of things make poor corporate governance, and there are a litany of things. So perhaps the easiest way is to find a company like Enron, like Parliament, like WorldCom, and just try and understand so that you can give examples in an exam of a company rather than trying to learn all of them. And Enron is a very good example. You need to understand what good corporate governance is and what a good corporate governance management team would be trying to do. And obviously, they're going to do things like minimizing risk, taking responsibility, having accountability, those sort of things that you're doing the right thing, if you like, about a business. And we'll look at this a little bit more in just a moment. Now, because this is a UK-based exam, you're going to be tested really on the UK Corporate Governance Code. In Australia, there is a different code. It's called the ASX Principles. But what they say in the tutor notes that I've given, students should be aware of the main provisions of the UK Corporate Governance Code. It's slightly different than the Australian one, but you need to be aware of that. The key thing in this particular area that you need to know is the difference between a principles-based system and a rules-based system. So Neil, tell me what's the difference between them.
Can you say that again?
Okay. In corporate governance, there's two types of systems generally in place in the developed Western world. One is called a principles-based system, and the other is called a rules-based system. Do you know the difference between them?
The principle is a set of definition and which the corporate understand the management of that company needs to follow. Then when it comes to the rules, it's like procedure manuals.
Okay.
Okay,
not quite right. What principles means is that the principles of corporate governance are given. So here's the principle: you must have, let's say, for example, non-exec directors on your board. That's a principle. And what it usually means is that if you don't do that, you have to explain why not. And this is the same in the UK as it is in Australia. If not, why not? If you haven't followed the rule or the principle, explain why you didn't do it. So that's what the principle-based systems are. In America, they have something called a rules-based system, which is simply regulations. You will do this, and if you don't, you'll go to prison. So that's the difference between them, and you really need to be clear about those two. Principles-based, we tell you what to do, and if you don't do it, you need to explain to the shareholders why you don't do it. The rules-based is you must do it, and if you don't do it, you're looking at a fine or certainly prison in some cases. Now in America, after the Enron crisis, they brought in some rules-based principles called the Sarbanes-Oxley Act. And these are regulations. You must do this, otherwise it's illegal. So that's the difference, and you really need to understand those two. It's very important. You also probably need to be clear about what the responsibilities of a board or the roles of a board of directors are, and what sort of people need to be on a board. Obviously, there's no, anybody can be a director of a company, but what the corporate governance regime would like to have is a board that has some certain qualities. So have some expertise that's relevant to the business that you're in. Have a mix of experience or diversity. Make sure board directors are trained, and make sure board performance is at least monitored or assessed once a year. You need to be clear about what the role of the board is, and most people forget that the principal role of a board of directors is to develop strategy. Obviously, most people think it's making decisions, but developing strategy is the basic fundamental role of the board. Once you've got a strategy, of course, then you can make some decisions. Making decisions without strategy is not a very good idea. They've got to oversee the management team. They've got to obviously monitor risk systems and control systems, and they've got to communicate with shareholders. So these roles of the board are important, and I think you'll be expected to know those and to at least talk about them. The board of directors in most companies in Australia, or at least listed companies, we'll talk about big companies, listed companies on the stock exchange, usually have a series of committees that help the board, and one of those committees is called the Nomination Committee, and their job is to help recruit and make recommendations to the board about maybe new directors. One of the principles about board management is that the role of the board chair and the CEO shouldn't be the same person. So there should be a separation between the chair and the chief executive. In Australia, because we are perhaps more aware of women, we don't use the word chairman anymore. I think that's still used in the UK, but we use the word chair. So the chair and the CEO are separate. And they ought to be non-exec directors, non-executive directors, which we will look at in a moment. The chair of the board is responsible to run the board and to communicate with the shareholders. And the CEO runs the management team, they run the operations, they run the control systems. The shareholders are the principals, the board is their agent. The board is the principal, the CEO and the management team are the agents of the board. That's how it works. We need to be clear about these things called non-executive directors. They're very important. Non-executive directors are people who are not executives of the company. They ought to be, in Australia certainly, they're defined as independent non-exec directors or non-independent non-executive directors. These are people that are appointed to the board who are independent and give independent advice. They've got no executive responsibilities, and their job is to provide an objective viewpoint balance between the management team and maybe the shareholders. And in some cases, in some board committees, there should be a majority of them. And in some cases, the board ought to have a majority of the best practice, for example, is that the majority of directors ought to be independent. That means they don't have any performance criteria. There's no real financial connection except they get paid and maybe they get a free lunch every quarter or something. What do? They work on committees, particularly things like the Nomination Committee or the Audit Committee. They're involved in dealing with external auditors, for example. They're involved in strategy. What sort of things would you like to have a non-exec director to have? Obviously, wide experience and knowledge. So what happens is, let's say you're the chairman of a bank, you retire, and straight away you'll get in the post or in the email a dozen offers to become a non-exec director of a board of companies. And why? Because you've got lots of experience, you've got lots of knowledge. Politicians will get asked to do this. You've got a wider perspective. If you've been in charge of a big company, obviously it's going to be comforting for investors. Okay. Some of the disadvantages of non-exec directors we need to consider is if they're independent, how do we know that they're truly independent? And we need to consider this. It may be difficult to impose their views, and really they're only one part of the board of directors. But most boards of directors in Australia will have a significant number of non-executive directors, so it's important. Now what I'm going to do is we go through these slides so we don't get bogged down with just lots and lots of words. I'm going to put in some learning examples as we go through, and some of them I've got the answers for you, and some I haven't. And what I'll do is I'll ask you when we haven't. So these are sort of things that you might get in an exam. Here's a little example about a chairman of a company. He holds 30% of the shares. He's been the owner of the company for 25 years. He was the managing director, but now he's promoted himself to the chairman, and he's appointed his deputy to the CEO. They've got a strategy. They've got two non-exec directors on a 10-person board, and they're described. And this is typical of the sort of short answer question you might get in the exam. Evaluate the corporate governance of this company. So what we don't want, because you won't get much time to do this, I mean, in an exam you'll get so many marks and you can work out how much time you can spend on this. So the first thing you need to do is to look at these verbs. Evaluate the corporate governance. And it simply requires you to make a statement of some sort. Is the corporate governance good? Is it bad? Is it indifferent? In this case, the corporate governance is poor. Why? Just give some reasons. The chairman's not independent. Okay, he owns 30% of the shares. How can he be independent if he owns 30% of the shares? This means he'll be still like the CEO. Although this happens in real life, one of the cases that I teach is financial reports. And if you look at, for example, Harvey Norman's annual report, this could seem like Jerry Harvey. He owns 30% of Harvey Norman. He's the chairman. Is he independent? No. But he's the chairman. In this case, it's not good corporate governance. He's still going to be interested in that. He's got no experience in this case of running a listed company. And so that's one reason why corporate governance is poor. The CEO has not been appointed by independent non-exec directors, so they've not got a nominations committee. The CEO has been appointed by the chairman, and the non-exec directors are only 2 out of 10, 20% of the board, and even those, if you look at them, are they really independent non-exec directors? Well, the lawyer can't be because he receives work from the company, so he can't be independent. And the other one is a politician who's going to get education contracts. So again, the independence or experience in this case may not be right. I think the other thing that's missing from this answer, and this answer's from the CIMA replies, is this thing here. We also need to consider that 70% of the shares of this entity are owned by people who are not involved in the board, like most companies. So we need to consider who's looking out for the interests of those 70%. That's important. So in this case, corporate governance is poor. Give some reasons and don't spend too much time or spend enough time on it as you need to. One of the key things about corporate governance, which will always come up, is excessive remuneration. And again, I'll read from the tutor notes. Students should look out in questions for remuneration packages that encourage excessive focus on short-term profits. One of the problems we've had in corporate governance over the years is people, CEOs or executives, getting paid large amounts of money when they perhaps shouldn't have. The most famous case, if you wanted to give an example when you're doing an exam, is a fellow called Robert Nardelli. He was the CEO of a company called Home Depot, a bit like Bunnings in America. He was hired to increase the share price of Home Depot, and after a couple of years, he was sacked. So Neil and Praveen, can you hear me okay? No. Neil, are you there?
Yeah.
Yes. How much did he get when he got sacked? How much did Robert Nardelli take home for being sacked from being the CEO of Home Depot? Have a guess. $50?
Might be something around 100 million?
Yeah, good guess, but not quite right. $211 million he got for being sacked. I wish somebody would sack me and give me that money. That would be nice. This money belongs to the shareholders. And one of the problems that corporate governance regulators or people that write the principles have is how can you not get these massive payouts. In the case of Robert Nardelli, he wrote his own contract, and excessive remuneration is a topic that comes up all the time. So what the principles in the UK code suggest is that the director's remuneration is set by independent board members. And they have things like, don't give people a long-term contract because if you fire them, you're bound to pay them out. Have bonuses related to measurable performance indicators. and have transparency in the annual accounts. You'll see if you watch the film Enron, they started a division of Enron, and again, it didn't work out, and some guy walked away with $125 million. Shareholders don't like this. I mean, if it was your money, you wouldn't like it either. So there needs to be usually a remuneration committee of the board, consisting of independent non-exec directors, and their job is to develop remuneration policy and develop remuneration packages. So you need to know about this. It's a very hot topic, and it's one that will likely come up in an exam. Service contracts. This means the contract for the employment of something like a CEO. Don't make it more than 12 months, because if you do and something happens, you're going to pay it out. You see this even in football clubs. English football, for example, they hire a manager for 5 years. After 6 months, they sack him, but they've got to pay out the 4.5 years. They're often private businesses, so it doesn't really matter so much. But in a public company, it gets the shareholders don't like it. The Sarbanes-Oxley Act, as I mentioned, is the US's response to the Enron failure, and they have, as I said, a rules-based approach. And the London Stock Exchange, which is part of the UK Corporate Governance Code, they have a principles-based. And what this principles-based thing is, you could paraphrase it by saying comply or explain, or as they say in Australia, using the Australian one, if not, why not? So if you're not doing it properly, explain in your annual report why not. So in the UK, they use the words comply or explain. So comply with the principles, or in your annual report, explain why you haven't, and that's the same in Australia. But in the Sarbanes-Oxley Act, for example, the CEO and the CFO have to sign some accounts, and if they sign it knowingly that it's false, there's a prison term of something like 11 years or something like that. So there needs to be some disclosures, and if you look at an annual report, for example, if you looked at Harvey Norman's annual report, there's a corporate governance disclosures, what sort of board committees they are, what sort of reports, what's their, how do they do risks, how do they do internal control reporting, do they do any sustainability or CSR reports. So a fair bit of disclosure is required. We need to consider the relationship with shareholders, and there are some changes here that are pretty similar in the UK as they are in Australia. Directors are required to submit for re-election every 3 years, so they have to rotate, and that keeps the board fresh. It sort of gives the shareholders a chance. So if there's 9 directors, 3 of them will resign every year, and maybe they'll put themselves up for re-election, or maybe they won't, or the shareholders may elect somebody else. So this renewal every 3 years is important. There's some recommendations about annual general meetings, which you're required to know. Again, I'll read some notes for tutors that we've been given. The chief features of effective GM's general meetings should be memorized by the students. What are these chief features? Well, you've got to give people notice of the AGM, at least 20 days. Most of it's done electronically these days. If you would see on the news, a couple of days ago, Qantas had their annual report. You'll see all the directors sitting up in front, and there'll be business presentations. In this case, Alan Joyce got up and did a presentation. There needs to be a question and answer session between the shareholders, and the shareholders have got to be allowed to vote on substantially separate issues, and this is to stop people wrapping up nasty things in something inside something else. So shareholders need to vote separately, and they need to vote on reports and accounts. And if you can't go to an AGM, of course, you can use a proxy vote. The UK and US corporate governance requirements are often talking about shareholders. They don't talk so much about stakeholders, and stakeholders are quite different than shareholders. Stakeholders are people who have an interest in a business, and they could be the employees, they could be the creditors, the banks, the suppliers, because these people, if something goes wrong, are not just the shareholders aren't the only one that could suffer. When you look at Enron, for example, most of the employees lost all of their entitlements. Most of the suppliers and creditors lost all the money that they were owed. The government lost taxes and so on. So we need to know the difference between shareholders and stakeholders, very important. And the OECD corporate governance talks a bit more about stakeholders than shareholders. Okay, I think that's probably all that is there, except I've got a little question here for you. How are we going for time? We're good. So I'm going to read this to you, and then I'm going to ask you some questions. Praveen, if you can hear me, I don't know whether you can or not, but you can. There's a little green tick at the bottom there. If you can hear me, give me a tick. I don't know whether you can hear me or not. Otherwise, Neil's got to answer all these questions, and it's not fair. Okay, so here's an extract of a statement for a UK company. It didn't comply with the recommendations of the code, and so here's some examples. This is the sort of thing you might get in an exam. Okay, Praveen, yes I can, sorry, I'm having some issues with my mic. Okay, good, as long as you can hear me, that's all right. So what you might get in an exam is a sort of question like this, where you've got a series of different scenarios, and what you've got to do is to consider, in this case, why these disclosures of non-compliance might cause investors concern. All right, so it's pretty a typical sort of thing. So let's have a look. The audit committee didn't have a chairman, only 2 directors. At least one of the company's other independent non-exec directors also in attendance. This ensured at least 2 independent non-exec directors attended each meeting. So, Praveen, you can use the chat if you can't speak or you're having trouble with your mic. What's the problem? What problem might have an investor have with this thing where there's an audit committee, but it doesn't have a chairman? There's only 2 directors, and there's at least 2 independent directors that attended each meeting. Is there any problem with that from an investor's point of view? Neil?
The responsibilities, I mean, who takes the ownership?
Well, it's a bit vague. It's a bit vague. One of the things we've got to do when we're answering these questions is be very much more precise about, I'm an investor. What might cause me concern here? Is there anything? I mean, you might answer nothing. Is there anything there that would cause me, an investor, some concern if I read this disclosure? Remember we talked about, if not, why not? So did the audit committee have a majority of non-exec directors? Did it have a chairman or a chair? And this is the reply that comes in the annual report. Okay, so Praveen, I don't know whether you can see this. Praveen, if you do to all participants, not just, and then Neil can see it as well. Okay, relevant experience is lacking in directors. Yep. At least one of them had relevant financial experience. So only half your answer is correct. Only half your answer is correct. So one of them had relevant financial experience. Let's think of it another way. And again, this is, you've got to think quickly in an exam. one of the problems you've got here, you've got two directors. What happens if they each disagree with something? Can you make a decision? No. No, it's very hard with two directors. So one of the problems you've got here is that where you've got an even number of directors, it's not always easy to make sure you can have a viable majority. All right, that's the first thing. There's no chairman. There's nobody in charge of this, so there's no authority there. So these are the two things that I would think about. Not having a chair and two directors might work, but there's no chair. We've got one director who's got financial experience, but the other hasn't. So is that going to work? No, I would be concerned if I was an investor. Okay. So we don't need to do all of these, but okay. I think that's probably enough of that. So when you're answering questions, we're going to talk about this in a moment when we look at ethics. What you've got to be clear about is dealing with facts rather than opinions, okay? So the information's usually here, and you've got to think it out. So the first thing is, doesn't have a chairman, only two directors. How can decisions get made? That's the key thing here. Okay. All right. So there's an answer which I'll leave here, and if you watch this film in the next couple of days, you can see the answer, or if you need me to send you the answer, just let Justine at CIMA know, and I'll give you anything that we do tonight. So now we're going to just talk about ethics. Again, this is a very important part, and I'll read again what the CIMA have told the tutors. Ethical issues could frequently be brought into questions, particularly the role of control systems in enforcing them, or considering how auditors deal with ethical problems, which is the reason why I've done auditing at the end. So let's just have a look at ethics and try and understand this. When you're a professional accountant, CIMA, just like other professions, CPA, CA, ACCA, they all have their own code of ethics. They're very similar. CPA, for example, also have these fundamental principles, and they're exactly the same because they all come from the International Federation of IFAC. So what you need to be clear about is that you need to abide by these fundamental principles, and you need to know the names of them. So you need to be clear that you know these 5 words or 5 sets of words very clearly, because you will get asked a question to identify some scenario, and they're going to ask you which fundamental principle has been breached or is going to be breached, and it'll be one of these. So you need to understand those. Professional behavior, what does it mean? Well, it's supposed to protect the reputation, but what does it mean in practice? We'll look in a moment. Integrity. Don't do anything false or misleading. Well, we need to understand, what does it really mean in real life? Professional competence, perform services with due care. Confidentiality of client information really, or confidential information from your employer. And objectivity, no bias, no prejudice, no partiality. Easy to say. And we need to understand this word conflict. There's nothing wrong with conflict. Conflict is a part of life. But you're going to have ethical conflicts. If you don't have them, then you're not really, I don't know. I've seen many in my business life, lots of ethical conflicts, and you've got to be aware of what these conflicts are and what they mean. Where you have divided loyalties or somebody's putting some pressure on you. So these 5, you need to understand what they are and what they mean and be able to write them down. So you need to practice to make sure what they are. What happens, and I don't think in your exam you're going to have to know all of these different types of threats, CPA, for example, who do a lot of auditing, they have a lot of threats in practice, in public practice, and they have a lot more than CIMA have in understanding what these threats. But again, these threats are important, that you understand what self-interest means, what intimidation means, what familiarity means. Okay, and what we've got here is what safeguards ought there to be to shield you against these threats to the fundamental principles. That's what these things called safeguards mean. And what sort of safeguards does a professional person have? Well, to be a professional, you've got to do what you're doing now. You've got to go through all of the hoops to get through exams. You've got to get some practical experience, etc., etc. And even when you've got your exams, you've got to do CPD. You've got to keep up to date. You've got to abide by these professional standards. And there's lots of laws and codes of conduct and codes of ethics that you need to have. They're professional safeguards. You also need to think about the safeguards in a workplace. And there are lots of different ways that these safeguards could be had. And it depends on the organization you're in, and it depends on the management team of that organization. So there might be some oversight systems about these threats. There might be some programs, some training programs that you might have. The major thing that you need if you're going to have safeguards against these threats is ethical leadership. The people in charge have got to demonstrate. They've got to walk the walk and do this thing. And again, if you watch the film Enron, you'll see the senior managers of Enron saying one thing to the employees and doing the exact opposite for their own self-interest up here. And so it's a good example here. There might be some training procedures, and there might be something called whistleblowing, where there's a process in place where people can talk to a non-exec director, for example, about something they've seen or heard, which is important. I'll read again for you. Ethical questions, ethical issues featured in the pre-scene should be carefully analysed, as they're very likely to feature in question 1. So when we come to the end of this session, we're going to have a look at the pre-scene, and what we need to do is to start thinking here about what sort of ethical issues might be in the pre-scene. And we'll have a look at that, because we're being told here quite clearly that they're very likely to feature in question 1. So the next thing is that CIMA wants to talk about the resolution of ethical conflicts. I'm going to come back to this because, no, we'll do it now. So let's take an ethical conflict. Praveen and Neil, can you think of a workplace ethical conflict, which I don't want to know anything confidential about your business, but just what sort of things might happen to you which might give rise to an ethical conflict? Can you think of something?
For example, the management might ask you to change the EBIT line of the organization, or do some creative.
Creative. Earnings management. They may say to you, look, why don't you just turn your blind eye to this or do this for me. Sometimes it might not be asking you to do something. It might just be asking you to turn a blind eye. I'll give you an example from when I was quite young, probably your age. I worked at a company and we had too much inventory, and the guy who was in charge organised for a big truck to come. They filled the container up with inventory and said to the driver, we've got the auditors coming tomorrow. Take the truck and come back. Go somewhere. We don't want to know where, but come back in a week. Okay. So, and I'm the management accountant. And what do? That's an ethical conflict. Praveen has just said a supplier attempting to bribe you to gain advantage. Yeah, exactly. So what do? In real life, it's much more complicated than just this list here, but this is what CIMA suggests you do if you have this in an exam. Gather relevant information, raise concerns internally. The problem is most of the conflicts are actually coming from senior people. Raise concerns externally. That means become a whistleblower, remove yourself from the situation. Sounds easy when you write it there, but in real life, not as easy, not as clear-cut. So, but that's the theory. In practice, obviously, it's quite different. So here's a typical short answer question you might get in an exam. You're an accountant with a company. You're providing services. They're all qualified. And it says identify which fundamental principles are compromised by each of the following observations. So first of all, it's saying identify. It doesn't say explain. So you could just get away with, for A, writing one or more of those 5 fundamental principles. So in A, you're frequently asked to complete tax. You've got no experience of tax other than you did 2 years ago, you're doing your CIMA studies. Which fundamental principle is that? Professional competence, due care. You don't need to put this because it doesn't say that, but it's just explaining it to you here. Professional competence, directors ask you to monitor a particular client. He's concerned they're running into difficulties, given a reference to the bank. He's promised to alert the bank if things start to get bad. Well, confidentiality. Also, could be professional behaviour, depending on how much he was an advocate. A list of clients where the directors feel are low value. You've been told ignore the phone calls, only do their work when everything else has been done. Yeah, professional behaviour. So you need to have a look at some of these examples for yourself before you do the exam. You need to be able to clearly identify which of these. It's either a yes or no in this case. So it's important that you are clear what those 5 fundamental principles are. Most businesses have a code of conduct, and obviously, just like accountants have a code of conduct, some businesses have written down their expectations of how they want their employees to behave. Nothing's easier than writing something down. Nothing's easier than making a manual. It's not going to work unless the people in charge actually do it. It's not going to work if it says one thing and they do another thing. It's not going to work unless people understand what ethics means. It's not going to work unless people have a commitment to ethics. There's lots of codes about, you can find lots of them. A lot of them have got a lot of nice fancy words in them, but basically this is the key thing. No code will work unless these things happen. What also there might be, again, Praveen, if you could use the chat function. Tell me, Neil, what you know about whistleblowing.
Access some sort of secret information and bring it to public.
Yeah. Again, that's a bit vague. A whistleblower is somebody that again, sees or hears something that they feel is wrong. Now, in Australia, there's actually laws that protect whistleblowers if certain conditions are met. And some companies have whistleblower procedures. And a whistleblower procedure might be, for example, and if you could write an example, if they ask you about whistleblowers, because it's very topical, an example of a procedure might be there's a hotline or an extension number with a messaging system on it, so like a voicemail, and you can leave messages there which will only be accessed, for example, by a non-executive director. Now that non-executive director has got to be very careful, because Neil could put on the message, "I've seen Praveen stealing money," or Praveen can do the same, "I've seen Neil stealing money." So we've got to be careful here. You can't just go out and say, "Okay, we're accusing you of stealing money." So the procedure has to also take into account that these things are, okay, Praveen, whistleblower, yep. These things are there to find genuine things that companies need to know. For example, if your boss is leaning on you to change the earnings before interest and tax, as Neil said, there's not much point in going to your boss and saying, "I think this is wrong." He probably knows it's wrong. Right? So if you put your hand up and say, "This is wrong, I'm not doing it," you've probably got two choices. You might keep your job, but you'll never go any further. You'll make an enemy of your boss, and you've got to prove it. So it's not a nice place to be, a whistleblower. So having these procedures in place is often a good idea, so that things could be done out of the public eye, so to speak, so you haven't got to confront anybody. I'll give you an example of how these things can go wrong. I used to be a financial controller of a business, and I had to sack somebody because he got drunk one lunchtime and crashed the company van, one of the company's vans, into a Mercedes. And I refused to pay the insurance. The insurance refused to pay, and I fired this guy for being drunk. A couple of days later, I had a bunch of auditors just turn up, and they went through the books of the business that I was the financial controller of, because they had a tip that I was stealing money. So you've got to be careful with these whistleblowing things. So whistleblowers is a very topical thing, and if you want to, there's a website called Whistleblowers Australia, which I think would be a very good thing to look at, because I suspect whistleblowers might be a topic that is very topical and might be something that will come up. We need to think about accountants in business, of which I guess most CIMA people are in business rather than public practice. Then obviously you've got some professional and ethical obligations, and in business there's more likelihood of you being pressured to do something than there perhaps is in a public practice, because the public practice people are independent. If you're an auditor or an accountant in public practice, you are independent simply by that. But if you're an employee of a company and somebody who's not high up in the hierarchy, or even if you are higher, you can be leaned upon by various people, and there's more threats in business. So you've got to be careful. You need to understand what your legal and ethical obligations are. What we also have to do is we have to report information accurately and timely, and all of those things that we need to do for people who we're being the agent for, the shareholders in some cases. We need to act with expertise. That means that we need, if we've got insufficient training to do something, we shouldn't do it. We shouldn't offer to do it. If somebody comes to you and says, "Can you do this job?" and you don't really know about it, you need to say, "Look, I'm not qualified to do this." One of the things that we're going to talk about is about accounting people and having bonuses or incentives. One of the key things that cause problems in business is having performance incentives. And one of the key questions, which I'm going to ask you in a moment, is why shouldn't accountants also have profit-related bonuses or something like that. Having a financial interest, like a bonus, a performance bonus, obviously leads to a threat, and that threat is self-interest, and we need to be careful how that works. In many companies, there are strict rules about inducements, about somebody offering you an inducement. In some companies, particularly American companies, there are rules like you can't accept a gift of any sort more than $50. In Neil and Praveen, in your businesses, do you have such a rule?
Yeah, I mean, in such as, yes, if you receive anything over 50, you got to declare it.
Yeah. $50 isn't much, is it?
Mm-hmm.
Yeah. I once worked in a company that was having a big tender for something, and the procurement manager woke up one morning and found a Mercedes car parked on his front driveway. That's a bit more than $50. That's an inducement. Yeah, it happens. So we've got to be very careful about this. It's very insidious inducements. Praveen's just saying, yes, I worked in a welfare organisation. Everything has to be claimed on a red. Yeah, exactly. So this is very common these days, that inducements can lead to ethical conflict because nobody gets something for nothing. And this is, you probably, if you live in New South Wales, we've had this thing called ICAC, where we've had a lot of people paying politicians for supposedly giving them money for their election fund, but you've got to see it as an inducement. People don't give you money for no reason at all. Okay, let's have a look at the next one. Now, this is, again, the CIMA are telling you how to gain marks in an exam, so I think you should pay attention to this very carefully. When you get these scenarios that we're talking about, you need to analyze the situation. You need to understand what are the ethical issues, and I'm going to give you an example in just a moment. Make clear, logical recommendations. So, one of the things, I teach a lot of other professional people, and one of the things that I find a common thing is that people confuse facts with opinions. And what you need to do, first of all, is just talk about facts. Whether you think it's good or bad, it doesn't matter. That's your opinion. Basically, you need to know what the facts are. Once you understand the facts and not opinions, you've got to identify what are the issues here and what are the fundamental principles that are involved. So before you rush to understanding and making a decision, you need to stop, identify the facts, what are the ethical issues, and what are the fundamental principles here. Now, this is a bit like driving a car. When you do your driving test, of course, you drive quite differently than when you're out on your own on the freeway. You need to do this in the way the examiner wants it. What are the facts? What are the issues? What are the fundamental principles threatened? What are the alternatives? And for each alternative, there are some consequences. And you need to think of the consequences. So only after you've done steps 1, 2, and 3 should you consider recommending action. And when you get to that point, you really do have to recommend something. I think you should do this or that. And the last part is, I think you should do this or that because. So they're telling you how to go through a step-by-step approach to one of these ethical issues. And I just happen to have one for you, which I'm going to ask you about. Should any element of an accountant's remuneration package, that's all of you, be related to profits earned by their employer or by the company? That's the first question. Does this represent too great a temptation to distort profits? So, how would you go about answering that? Praveen, you could maybe use the chat, and Neil, you have a think about it and tell me, how would you answer that question? Praveen is saying this is wholly against an accountant's ethical boundaries. I don't agree with that. I can tell you, as an accountant who was also, I've been lots of businesses. I've been financial managers. I've been in charge of the office manager. I've been an accountant, financial accountant, management accountant. I've earned most businesses I've worked for a lot of money, not necessarily by selling something, but let's just say, for example, I'll give you an example. I once worked for a company where we bought $20 million worth of satellite equipment from an American company. But maybe by structuring the contract in such a way, I might have saved this company a couple of $1 million. Is that not worth a reward of some sort? Neil, you've had time to think now.
Yeah, I mean, answering the questions, I'll say it's fair because the accountants do participate in setting the annual target of the organizations.
Oh, okay.
Yeah, so
yep.
they have a professionalism by analyzing the past and also forecasting what is going to happen in the future.
Yep. Okay. Agreed. Yep. So how are we going to answer this question? Praveen is saying the temptation factor is my main concern. Okay. We've got somebody else with us. Let's see if that person's Kazia. Can you hear me? No, not yet. Okay, so let's think about this for a moment. What we've got to be careful of here is this question about this word here. We've got to look at the facts of this question. It's talking about remuneration package related to profits. Now, I agree. I would be very, very cautious about making any accountant's salary package linked to profits. I would be very cautious about that. So what else could we do? Is there nothing else? It's either profits or nothing. So one of the things that we've got to think about are the facts here. So maybe profits is, so what we're talking about here is, let's for example, go back to our non-executive directors. They get paid. They get paid for being a non-executive directors. Accountants are paid to do publish accounts, but they're also paid to do lots of other things. And I think it's unfair. I worked for a company, I was in charge of the finance department, and I really had a problem with the management of this company I worked for, because they'd have these annual things where everybody got prizes. The secretary of the sales manager got a prize. Everybody got prizes, but nobody in the accounting department got anything. And I used to complain bitterly about this because we worked long hours. So why can't we get some reward? The thing that we've got to is that we don't need to link it to the company's performance or profits. There are lots of ways that we can find to reward people. We can reward people, for example, by using budget variances or something like that, or key performance indicators or something. we need to be fair to people. And just because I'm an accountant with a code of ethics doesn't mean that that's all I do. An accountant, particularly a management accountant, they do lots of things. They get involved. I used to get involved in negotiating tenders, fixing prices, working out net present values, running projects. I was as much a part of the business as the salespeople, and yet I was excluded. So there's got to be some balance here. And what we need to do is to find a way of rewarding people that is fair to the accountants, but doesn't allow them to be tempted to earnings manage. That would be the sort of answer that I would be looking for. Okay, that's, I think what we might do now, just so you can go and have a cup of tea or a walk around, is we might have a 5-minute break. It's 8:05. If we come back at 10 past, and then we'll do financial risks and auditing. Is that okay with both of you, or all of you? Yep.
Yes.
Okay, so I'll see you in 5 minutes. I'll pause the recording. Now. So welcome back. The reason I've included Chapter 8 in this first session is because in the notes to the tutors, it says quite clearly, the examiner has stated there will always be a financial risk element in compulsory question 1. That couldn't be clearer. So there's a lot about financial risk in P3, and in the next 2 weeks I'll be covering more of it. But I wanted to touch on it tonight because there's some elements of this that we need to consider in the pre-scene material, which we'll look at when we've finished Chapter 8 and the chapter on auditing. So let's move on. I'm not going to go through all of this. There are lots of different risks in business, but I want to, again, give you a note from CIMA to the tutors. Students may be asked to describe how risk influences important business decisions. For example, the decision to whether to raise floating rate debt or the currency in which the business borrows money. And when we come to pre-scene, obviously this is going to be one of the things that I'm going to point out to you. Now, I'm not sure how much of this you did in earlier ones. What we might start off with is sensitivity analysis. There's a little thing here underneath your names. You can see, I'm just going to do it now, you can see a little tick and a little cross. And I might ask you a question, and if you agree, you might give me a tick, and if you disagree, how many of you, and give me a green tick, how many of you understand what sensitivity analysis is? Yeah, Praveen says yes, Naminda says yes. I presume you've done this in previous things. Neil?
Yep.
Yeah, you can give me a tick like that. Okay. Kazia? Yes or no?
Yes.
Okay, good. Thank you. Okay. All right. So you can switch. Whoops. You can switch your little ticks off now, if you will. Okay. So I don't. If I ask you that, that means I don't have to go into it and explain what it all is. So that's good. That saves me some time. Sensitivity analysis. We've done things like net present value. You understand what that is. What sensitivity analysis is trying to do is to work out which of the variables in an investment decision is most sensitive and therefore needs to be tested. Any of you that have done a net present value investment decision calculation, you ought to know that cash flows that you predict are so ephemeral, they're so likely to be wrong that you need to do more analysis, particularly if you're getting a high net present value, you should be very suspicious about it. And one thing that people do is once they've done a net present value, they then do sensitivity analysis to try and look at these key variables, and there are lots of variables that could be, to find out which is likely to be the case. A simple example, here's is you've got a positive net present value on an investment of $500,000 of $80,000. Obviously, we can afford a 16% error of that $80,000 before we get to the break-even point where net present value is zero. That's the idea, general idea of quantifying risk. Here's an example for you. We've got a little net present value. We've got a $100,000 investment. We've got some contribution and some fixed costs and the same amounts for every year. So we've discounted at 10%. We've got a present value of $20,640. And you might get asked a simple question like this: what's the sensitivity of this net present value to each of the variables? The initial investment, the contribution, the fixed costs. And you can simply work it out with these calculations here. 20,000 on 100,000. So there's a 20% sensitivity to the investment. And if we look at the contribution, 10%, and the fixed cost, 25%, it tells us, therefore, that this is the one that we have to be careful of. This has only got to fall 10% for there to be no net present value, no profits, in other words. These two look so bad. So if we were going to investigate further into this net present value example, we would start off with looking at the contribution and maybe do some more work, maybe do some more analysis to try and understand it. So that's the general idea of sensitivity analysis. We've got a couple of other things that you've probably done before. I think it says you've probably done these in earlier exams. Certainty equivalent. This is all about adjusting the cash flow to get certainty. The classic one that I think about when I think about uncertainty: you've got a job, you're earning $80,000, $100,000 a year. You're tempted to go into business on your own. You don't do it. The certainty equivalent is your salary. I'm certain of that. I don't want to go on risk. So the certainty is how much of this cash flow could we be certain about, and could we then discount that? We've got this thing called expected value, which is where we've got the probability of certain things happening, and there's an example coming up in a moment where we've got a probability of something happening, worst case, best case, base case, or something like that, different probabilities, and usually using something like standard deviation. And so what we're going to do is we're going to work out the NPV for each of these worst outcomes and work out a standard deviation. So we'll have a look at that in a moment. I think we're going to look at value at risk also in this example in a moment. Regression analysis, I'm sure you've done that in earlier P1 or P2. Simulations and scenarios, they're very connected with what we've just done, which is the sensitivity analysis. So let's have a look at this example. And this is a sort of simple, not so simple calculation that you might get. So you've got what are the gains or losses on something? In this case, it's a daily trade. It's distributed about a mean of 0, so I'm giving you a normal distribution here, so it's distributed normally. There's a standard deviation of 10,000, and the daily VAR, which is this value at risk, is 5% confidence. Now, I've put this normal curve in here so that you can see where this value 1.65 comes from. I presume, I'm presuming in P2 you did this, so I'm not going to go into it too much. But in this standard deviation curve, 5% standard deviation is about here, and if you go down, it's about 1.65. So the VAR, if you like, the value at risk, is 1.65 times $10,000, 16,500. So you can work out there's a 5% chance of a daily loss of 16,500. That's the sort of idea. And there's a couple of learning examples if you need more, but I think probably you already covered that. You need to also refresh the knowledge that you have about these terms, about investment appraisal, what sort of things that we're talking about here, minimum, maximum payback, obviously a maximum payback period. The longer you have a payback period, the more risky it is, because obviously you're trying to predict something that's way out into the future. High discounting rate, obviously if the more risk there is, the higher the discount rate, and so on. So I think probably that investment appraisal, I'm assuming that by P3 you know something about that. So I don't really think I need to spend, but I need to read to you something that CIMA has said. Value at risk, which is this calculation here, has been highlighted by CIMA as a particularly important technique. Exams are likely to include value at risk calculations regularly and discussions of how the technique is used. So what I'm suggesting to you, that if you're not familiar with value at risk calculations, is to make sure you do become familiar. And in particular, to understand the standard deviation process to get these normal value elements. The Treasury function, again, I'm just going to touch on this financial risk area. I'm going to come back to it next week, but I just wanted to start on it because there's something in the pre-scene that I want to talk about. Again, a note from CIMA to tutors: students need to understand how the Treasury function can control the financial risks the organisation faces, and how a badly controlled Treasury function is in itself a significant risk. So how many of you, again, give me a tick or a cross, how many of you in your organisations that you work for, how many of you have a Treasury function? Yeah, Dominda Kazi says yes. Yep, Neil. Oh, you're probably on an iPhone, are you, Neil? So maybe you can't do it. Okay.
Yeah.
Okay. Yeah. Sorry, I just realised I saw the signal. Do you have, Neil? Do you have a Treasury function?
Yes.
Yeah. Okay. Why? Why do you all have a Treasury function? Why?
To manage the fund of the organized company.
Yeah. Can you be more specific?
Because,
isn't it to manage the risks?
Yes, yeah, because it's the fund are attached to the risk, so you got to manage your risk. Yeah, it's to manage risks of the funds being misused or not used efficiently or something like that. Yeah. Okay. Yeah. Okay. So you need to know, therefore, what are the risks that a Treasury function has. Okay. So the first function is the obvious one: running out of money. So you need a cash flow forecast of something. We need to think about, what have I got to pay next month? Because if you run out of money, the business is going to go down the tube. So that's the obvious one, but often people forget that, but it's a very important one. The second one is to consider hedging. For example, if you're buying stuff from another country and you're paying in another country, obviously there's some risk involved from currency movements. If there's a time lag between when you make an order and when you pay for it, there's obviously the potential of a downturn or an upturn. I used to work for Reuters a long time ago, and Reuters, we had long discussions about how much we should hedge. And in the end, the board of Reuters came down with a policy that they would hedge 50% of any currency risk. 50%. That was the policy. And from a controller's point of view,
that took away a lot of the problems for me because I didn't have to worry about it all the time. If you've got a currency risk, hedge 50%, leave 50% open. So having a policy about hedging would be useful. What are the risks? Failure to communicate exposures. If you want to have a think about what could happen if you had a poor treasury function, have a look at the case study about Barings Bank. What happened with a guy called Nick Leeson in Singapore that caused Barings Bank to fail. Poor communication, lack of flexibility, and difficulties exercising your control. You need to understand what sort of things could go wrong. What are the risks involved with the Treasury? It's something CIMA's particularly outlined for you. What sort of, again, financial risk management, I'm going to cover some of these things later, perhaps next week. There's lots of risk management strategies that you can have. Obviously, hedging, if you've got a natural net, if you've got an income stream in US dollars, then obviously you've got a natural hedge. Working capital management, internal things, there's lots of things we can do. We're probably going to talk about debt and equity and international currencies. We're going to talk about forwards and futures and options and so on. So we'll come back to these particular risk management techniques next week. I just wanted to touch on it this time because now another point that again I need to read to you again from CIMA. The new P3 syllabus requires knowledge of the principles of valuation of financial instruments for management and financial reporting purposes. Calculations in this area are likely to be well signposted in questions, and students might be expected to use the knowledge that you should have got in F2 about accounting standards when discussing risk and control problems relating to financial instruments. So I'm going to come back to that next week, but I just wanted to flag that you need to consider the accounting standards in the area of financial instruments, in particular IS 32 and 39 and IFRS 7 and 9. I don't think you're expected to know those in detail, but you need to know generally what they're talking about. So here's the disclosures, and what we're talking about here is disclosure of information about financial instruments, and the first part is categorizing them, where to put them in your balance sheet, for example. How do you treat interest? How do you treat dividends? And in particular, one of the areas that we're going to look at next week is this thing called fair value. So we need to understand how fair value works, and in particular, what happens if that fair value is different from book value, of course. And so we'll have a look at how fair value works in more detail next week. We need to look at, and we will look at more about hedging, and what are the exposures to risks, and we'll come back to that next week. And one of the things that you need to know are the risks associated with using financial instruments, again related to international accounting standards. And the reason I'm saying this is because, again, I want to draw your attention to a couple of things in the pre-scene. And some of the risks, and you need to know what these risks are. Obviously, the accounts risk, something's going to be put into the wrong area of the balance sheet, or it's going to be treated wrong, or it's going to be disclosed wrongly. There's going to be some income risks. So if something changes its value, so the fair value of something changes, obviously it's going to have an effect on the statement of comprehensive income. There's going to be system risks, because you've got these things, if you're dealing with financial instruments, you've got to have a computer system or an accounting system that will allow you to manage them. And obviously, if you're got to think about reputation certainly with your shareholders, if you have to write down assets because of these changes in fair value. So again, we just need to touch on those at this point. We don't need to go into them in too much detail. We're going to touch also next week and more in week 3 about the processes and systems and controls. So we'll come back and deal with those at that time. Okay, I want to go through auditing because it goes back to what we talked about in the beginning, which is related to corporate governance and reporting, and particular down here when we get to the audit committee. Now, P3 talks in chapters 15 and 16 about internal audit, and you've got to be careful that we're not talking here about external auditing or independent auditing. We're talking about internal auditing. Many of the things are similar, but again, I draw your attention to that word internal. So if you've ever been involved in internal auditing, you understand, of course, that there's got to be a lot of planning about it. And usually, for example, if you are involved in internal audit, you might have a plan to cover something you might have a 6-month plan, a 12-month plan, which areas you're going to cover, how frequently you're going to cover these, and you might develop a program, and you might have a plan for each individual audit. So how many of you, again, give me a tick or a cross, how many of you have permanent internal audit functions in the place that you work? Kazi says yes, Dominda says yes, Praveen says yes, Neil?
Yes.
Yes. Yes. Okay, so this is a common thing. You ought to know about this. How many of you, again, Dominda, if you could just uncheck your thing for a moment, because I'm going to ask you another question. How many of you actually go and talk or have gone and talked to your internal auditors about this P3 subject that you're doing? How many of you actually done it? Kazi says no. Praveen says no. Dominda says no. Neil?
No.
No. Why not? You've got these people there. They've got lots of experience. Find some questions and go and talk to them. I'm sure they'd be delighted to help you. It seems to me crazy that you've got these resources there and you don't use it. So what we need to be clear about here now is we talked about business risks. This is what we're talking about. The risks involved with running your business. And those risks are multifarious. Could be in the structure of the systems, the people, all sorts of things. You need to understand these two terms, inherent risk and control risk. And you need to understand it so that you can give examples. And the easiest way to understand it is probably to find examples in your own business. You go and ask somebody in your internal audit function, give me some examples of inherent risk in our business. Give me some examples of control risk. You'll remember it. Much easier than doing that. So what is inherent risk? Well, these are the risks that can't be controlled by an auditor. These are the risks of the nature of transactions, the complexity, the reputation, inherent risks in doing business. Okay. In control risks, how do people go about doing things? How do changes in things, how are they controlled? And one of the things that we look at if we're doing auditing, and I've been involved in auditing for some time, we look here, for example, that many of these control risks happen when there's a lot of change. When change happens, there's lots of control risks. When growth happens, when there's more transaction, more complex thing, you've got more inherent risk. So you need to be clear and to be able to give examples of inherent risks and control risks. Right? So which are these two? In reality, people in business generally don't separate them into these things, but auditors do. And so you need to do that. You need to understand these two. So let's have an example here. Here's the sort of thing that you might get in an exam. So we've got a little scenario in this case. Identify the levels of inherent and control risk in these companies. I've only put one in here. For each type of risk, so inherent or control risk, state whether you think it's high, medium or low. So there might be an inherent risk. Is it high, medium or low? There might be more than one risk. Is there other control risks? So here's a little scenario. A construction company builds residential buildings. The manager's worked his way up. He understands how to make profits in this industry. He employs cheap labour, and he knows where to go and find casual labour. He can use his knowledge of the industry to take shortcuts from what he calls overly prudent health and safety bureaucracy. So he cuts corners here. He's been successful. The company's profit making, but recently had problems with a group of workers who's had to fire due to theft of expensive building materials. So what's the inherent risk? Well, it's low because he's an experienced manager and the company's successful, it's profitable. But the control risks, controls about theft, controls about people, group of workers stealing something. Obviously the controls aren't in place. So in this case the control risk is high, but the inherent risk, because he knows what he's doing, the business is profitable, the inherent risk is low, but the control risk is high, and you just need to give something. So this is the sort of question you might get asked about the inherent and control risk. Another thing that is important to understand is about audit evidence. And there's, sorry, I'm just going to mute it a minute. Oh, it's, okay, Neil, I've just muted you in a moment, so if you need to talk to me, just use the hand signal like that, because I'm getting some feedback from you. Obviously, there's for an auditor, there's a requirement to have evidence of an audit, and we're going to talk about tests of control and something called substantive tests. But you need to be aware of what this requirement for evidence is, and I'll read again to you what the CIMA says about the topic. Students may be asked to recommend audit tests that can be used to assess adequacy of controls in a particular business area. Okay, so we'll look at that in the next slide. You just need to understand about evidence. That evidence has got to be appropriate. It's got to be of the right quality. We also need the right quantity of evidence, but the quality of evidence is important. So external evidence, something from your bank about the business, is probably more reliable than an internal memo. Auditor evidence is probably more independent than obtained from the entity. Written evidence is more reliable than spoken evidence, and original evidence, original documents, are better than photocopies. So you need to have just some understanding of the quality of audit evidence needed. You need to understand these two terms, the tests of control and substantive tests. And control is about systems and how they're designed and how they're operated. Okay, so tests of control are about systems, and substantive tests are about something called assertions. Assertions are things that they're made, but they're not actually said as the word assertions. But once, for example, in an external audit sense, if the management of a company gives to the auditors a set of financial statements, what they're doing is that they're making assertions about the information in those statements, and they're asserting, for example, if they've got an asset on the balance sheet, that asset actually exists. It's really there, and as an auditor you can go and find it. The management are asserting that they have the right, that asset is theirs at the relevant date, so at the date of the annual. If they're talking about a transaction, an invoice was processed into the general ledger, they're saying the occurrence took place, the occurrence was complete, there's nothing unrecorded or incomplete. And if we value something, like we value inventory, or if we value something, it's appropriate carrying value. If we measure something, if we disclose something. So every time somebody gives an auditor a set of data, those statements that they're given have a set of assertions in them. So you need to understand this word assertions. And what people do is what auditors do is they try and substantiate these assertions. Okay, you say you've got some assets on your asset register, let's go and find them. Let's go and see them. I want to look at them. I want to check the serial numbers. I want to check the condition of it, and so on. You've all been through this. You've all had, auditors do this. And they do this by audit procedures. So they do this substantive testing by audit procedures. They do a stock check. They walk around with you. Open that box. Let me have a look at it. They inspect documents. They observe things. They make inquiries. When did you do this? How did you do this? They confirm things. They write to the bank. Can you confirm that we owe Mary Brown or something? They calculate things. Last year's ratio gross margin was 25%. It's now 48%. What's happening? Analytical procedures. So this is what these tests are doing. They're trying to substantiate the assertions of these financial statements. Auditors do lots of sampling. You don't have to know all of the sampling types. There's lots of sampling types. The reason they do sampling is because you can't test 100% of all of the items. It's impossible. So they often take a sample, let's say a class of transactions, and they use different methods of sampling. Sometimes they do random selection. I want to look at every 5th invoice. That's a random selection. Or I want to look at every invoice over the value of $10,000. Or I want to look at every invoice that has some term in it. Okay, and so on. So there's lots of different ways they do sampling, and the idea is that they take samples, they make some assumptions based on those samples. You need to know what this acronym CAAT, Computer Assisted Audit Technique Software, is. Basically, somebody will turn up to your audit, or if you do an internal audit, they'll have a computer system with this computer-assisted audit techniques. What they're going to try and do is they're going to try and process some data. They're going to test your system. You've got might have an ERP system, you might have SAP, you might have some simple system, but they're going to process some data and see what comes out the other end. So they're going to do some sample transactions. So I'm going to feed into this system 100 invoices, and I know what should come out the other end into the general ledger because I've already done it, and I'm testing your system. And what they're doing is they're comparing the results. Okay. and so on. So this is audit sampling and catch. So there's also this word called an analytical review, which you need to understand. And the analytical review is simply using things like ratio analysis to try and understand financial statements. For example, we might use ratio analysis or comparisons. Last year, the margin to sales was this year it's that. Why has it changed? There might be some non-financial things that we look at. Customer satisfaction was this, now it's that. What's happening here? Might be some benchmarking. The inventory turnover in your industry is 12, and yet yours is 4. What's the problem here? And so on. We might look for relationships, or auditors might look for relationships between different financial information. So maybe there's a relationship. Maybe, sales are connected to the weather. You have a seasonal product. The weather's been fantastic, but your sales haven't gone up as well as you should have expected. What's happening? So they're looking for relationships between data. And this is what's called an analytical review. They're trying to identify unusual situations that may require further investigation. And we talked about ratio analysis. Got to be careful of ratio analysis that they're not distorted. I'm sure you're familiar with that. They're going to look at trends, and they're going to look at reasonable tests. How does it compare with the budget? How does it compare with the general business? The industry is growing at 12% and your business is going backwards. Why is this? So again, I'll read to you. Students must be able to suggest ways in which analytical procedures, these are the things we've been talking about here, would be used to identify risks and as evidence in an internal audit. For example, a review of expenses. Students may be asked to use a set of financial statements to draw conclusions on where risk areas lie. Well, we've got a set of financial statements. It's in your pre-scene. What we're going to do is have a look at that in just a moment. So here's an example that you might get. State some comparisons you could make if you were auditing the revenue of a chain of health clubs. So again, every organization is different. The revenue figure is made up of membership fees, but also from income from the cafeteria and sales of sports equipment. So you might be given some piece of information like that, and you've got to state some comparisons. So it doesn't ask you to state measures, it says particular measures, in this case comparisons. Monthly new members compared to last year. So you've got to make sure this word compared is here because you've been asked for some comparisons. So be careful, you read the question. Monthly renewals compared with complaints, relationship. Has the number of complaints gone up? Has the renewals gone down? Is there a relationship between them? Trends in economic data against disposable income. Percentage increase in new members. Does it match the percentage increase of sales in the cafeteria in the shop? If you've got 50% new members, you would expect to see some considerable increase in the expenditure or purchases in the cafeteria and so on. So comparisons. Finally, we've got this talk about reporting. What sort of contents of a report might there be? I think you're all familiar with reports. Usually there's a standardized format of audit reports. What are the objectives? What are the risks of the current practices? What did we find? Some control weaknesses. What were their causes? What were their effects? And what are the recommendations to fix them? I'm just keeping my eye on the time. We need to go back now to where we started tonight with the corporate governance, because the audit committee is specifically involved with internal audit and external audit. And obviously the audit committee is a formal committee of the board, and one of their responsibilities, or some of their responsibilities, are to review internal controls, to review risk management systems, and to review the monitoring or the effectiveness of the internal audit function. So internal audit and the audit committee are related. The audit committee will also be involved with the independent or external audit function as well. What are the benefits of this? Well, obviously it's going to improve the quality of reporting. It's going to strengthen the position and the independence of the audit function. And obviously it's going to increase confidence, not just of the public, but also of shareholders. There's some duties of an audit committee, and you need to at least understand what they are. Okay, this is my last example, and then we're going to look at the pre-scene. You're being contacted by a friend of yours, Arabelle Raven, who is managing director of a medium-sized construction company. She's carried out some projects for Nevermore, a listed engineering company. They've contacted her about becoming a non-exec director. Responsibilities might be to be a member of the audit committee. She's a construction engineer. She hasn't got a finance qualification. She's unsure if she's the right person. Explain to Arabelle the role and responsibilities of the audit committee. So that's part one. So that's just simply going back here and saying, these are the duties of the audit committee, just a list, nothing to do with this particular case. All you need to do is list the roles of the audit responsibility and the main qualities that a member of such a committee should possess. So you don't even have to refer to this case study here. You've got to just repeat these sorts of things here. Okay. So here's an answer for you. Again, I'll leave this open for a moment. And so the qualities of the member of the audit committee should have independence, preferably financial experience. If you're dealing with auditors, if you're dealing with financial statements, it does help if you've got financial experience. And financial experience also means financial literacy. And you've got to have some overview, you've got to have some knowledge of the company's business. Okay, I think that's all. Audit committee, yeah, we've done that. Okay, so what I want to do now is, I've got about 8 minutes before we finish. I want to talk to you about the pre-scene. So let me just open up the pre-scene for a moment. Let me just find it a sec. Just bear with me a moment. So how many of you are familiar with the pre-scene? Can you give me a tick or a cross? Fauzi says yes. Yes, Praveen says yes. Deminda says no. Neil?
No.
No. Why not? Yeah, how many weeks out from the exam are you? Not many weeks out from the exam. Okay. This is a very poor quality what I want to do is, I'm going to go through this pre-scene in much more detail, but let me try and open this in a different way. I'm sorry, you can't see it very well here. So I'm just going to pause the recording for a sec. You're going to have to add some cost to the bottom line. So the idea of this pre-scene is that you need to study it and to identify those things that are likely to ask questions about. And so what I'm going to try and do, I've given you a hint about it tonight. There's 4 or 5 things that we've covered tonight that might be important. And we've talked about the Treasury function. We've talked about the fact that they're buying things in foreign currency. We've talked about the fact that their loans are due to be repaid in 2 years. We've talked about the fact that they're going to close some stores. And we've talked about the fact that their board structure is probably not effective because they've got an equal number of non-executive directors as executive directors. And so you could see there could be deadlock here. We've also got to consider, although we're not going to do it tonight, we've got to consider that there are 2 other business operations here. And we need to look, for example, at what they're doing here. So, for example, you can see that they've got 2 divisions and yet they've got common functions here. They've both got finance functions, they've both got human resource functions, they've both got information technology and so on. So that gives you an indication that there might be some scope there to rationalize those and have one finance function or one HR function or one IT function. And they could be risks because they've got different ones here. So the idea of this pre-scene is for you to look at it, analyze it, and try and understand it. So when you get to the exam and they flick in front of you the next 3 or 4 pages, you can quickly relate what's on those 3 or 4 pages to what's here. And you can't be passive about this. You've got to be active. And so if you haven't read it, Neil, I suggest you do. And soon. All right, I think my time is up. Anybody got any questions? Anybody got any questions? Yeah. Yes, Kazi, you got a question?
I was going to say no, thank you.
Okay, good. All right, so what's going to happen next week, because I don't have any questions from you, is I'm going to pick another 4 chapters and I'm going to go through them and try and relate them to, at the end, I'm going to try and relate them to this pre-scene. And I'm going to try and pick the chapters that I can see that CIMA have said there's likely to be some questions here. So next week, it'll be more on the financial risk, and then the following week I'm thinking about doing the IT part, the controls part. So, so that's it. If you want to watch this film again, I've recorded it. I'll be giving the, it'll be in an MP4 format. I'll give it to Justine at CIMA tomorrow. She'll put it on the website and send you a link so you can watch this again. Please, by next week, if you can, read this pre-scene, not just read it as if it's a novel, but try and understand that each of these clues, it's like a detective story. There are clues in here that we need to identify so that we can not spend too much time looking for them when you're in the exam room. You'll have 20 minutes, but you'll have 5 pages to read, extra ones, and then you'll have some other questions that you need to understand. So you can't spend too much time. You can't wait till then to understand this pre-scene. Okay, everyone, that's it from me. I'll say good night and hope to see you next Monday. And maybe if you're doing F3, I'm going to do F3 on Wednesday. One of my colleagues, Marcella, is going to do the other one on Tuesday. So we might see some of you then. Okay, everybody, so good night and see you next week.
Thank you. Bye.
Okay, a pleasure.
Thank you.
Okay.